Hello and welcome to this session in which we will discuss steps in a review engagement for interim reporting, interim financial reporting. Now in the prior session, we focused a little bit more on this term, interim financial reporting. We defined what it is. If you don't know what interim financial reporting is, please go back to the prior recording. And we had several sessions about review engagement. What's a review engagement? What's the purpose of it? To review the financial statements. How do we do it? So on and so forth. In this session, the only difference will be is we're going to be conducting a review engagement, which we should be familiar with this, about interim financial reporting. And we should know what interim financial reporting, it's for a period less than a year, aka quarterly financial reporting. And specifically, we will be focusing on issuer or publicly traded companies. Now, those are the steps that we will be working with, which are establishing understanding with the client, learn and understand the entity and its environment, conduct inquiries, perform analytical procedures, perform other procedures, obtain a representation letter, evaluate the result, and obviously, last but not least, communicate the results. Now in this session specifically, I will focus on how to establish the responsibility, why is it important, and how to learn and understand the entity's environment. If you are looking at this list and you're saying, hold on a second, I saw this list when we did a review engagement, when we learned about the review engagement under SARS, that's perfectly fine. That's exactly what we did. Yes, indeed, those are basically the same steps, except we are focusing today on public or issuer, publicly traded company or issuer. So it's going to be a little bit different because of the nature of the beast. What's the nature of the beast? Publicly traded companies are publicly traded. So you might have to do a little bit more work because your job as an auditor, as a reviewer of these financial statements is exposing you to a wider audience because those companies are issuer, publicly traded. This is what we will discuss. No worries, we'll focus on these steps, step by step, starting with establish understanding and learning and understanding the entity in this session. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
The first thing we need to do when we agree to perform any type of work with any customer is to establish an understanding, a clear understanding with the client about the procedures. What are we going to be doing? Conducting a review of interim financial reporting. Why? Because we want to avoid any misunderstanding, because review is different than an audit. Audit is different than compilation. Compilation is different than reviews. Preparation is different than audit. So this understanding help avoid any misunderstanding and ensuring that both parties, the auditor and the client, are aligned on the expectation, responsibility, and the objective of the engagement. So we know exactly what we're doing and what we're gonna end up with. So bear in mind, the auditor will have to follow specific pre-acceptance procedure, and in this understanding, they have to spell it out in an engagement letter. So first, what are the pre-acceptance procedures? Simply, when you talk to the client, you want to make sure that they understand what's expected of them. Now, you're going to put it down in an engagement letter, but you want to tell them before we agree, you know, the auditor should perform a series of pre-acceptance procedures. Like what? Look, these procedures just to make sure that the auditor can effectively conduct the audit. Not the audit, conduct the review. Or if they're conducting the audit, you have to have also some sort of a pre-acceptance term. So they know what's expected of them. You know what's expected of yourself. The first thing is, which framework we will be using. So you will tell them, look, are you using GAAP? Are you using cash basis? Do we want tax basis? Do you want IFRS? So the auditor must confirm the financial reporting framework. I always call it the measure tape. I'm measuring something. I need a measure tape. What is the measure tape? What is the framework that I'm using? Well, in the US, we use US GAAP. If you're using IFRS, you're using IFRS or any other relevant framework for that matter. Also, you want to make sure that the management agree and it acknowledges its responsibility for certain things. What are they? Well, the management is responsible for the fair presentation and preparation of the financial report. They're always responsible for this, whether it's in interim financial reporting or complete financial statements. It does not matter. Management is responsible for the financial presentation. 2, management is responsible for the design, implementation, and maintenance of the internal control. Management will provide the auditor all the information that's necessary. Access to people, because we're going to need to talk to people. Access to document that we need to review in order to be comfortable with all of this. So this is basically making sure the management is aware of this. Then you put it down in an engagement letter to formalize the agreement and reduce any likelihood of misunderstanding. You say, okay, here's a letter. Let's spell out everything. It will outline the specifics of the engagement, making sure the auditor and the client have shared understanding of the work to be performed. Now you're saying you are repeating yourself. That's fine. Repeating is not bad. It will increase your retention. So the letter would cover the following key areas. The objective and the scope. What's the objective? Reviewing interim financial reporting. Clear. This means one thing and one thing specifically. Also, we need to talk about the scope. What is the scope of this? We're not conducting an audit, which involves a more extensive evaluation. A review is less comprehensive, and you have to spell this out in the letter. In a review, we conduct inquiries and perform analytical procedures to assess whether the financial information is reasonable. That's it. That's what we're doing. So we're spelling it out for you. Then we put down the management responsibilities. What are those? I just went over them again. Management is responsible for the fair presentation of the financial information, making sure that the information is accurate and complete in the statements. They're responsible for the design, implementation, and maintenance of the internal control. Again, repeat. Management will give us access to people, documents, whatever we need in order to review the financial statements correctly. And also management would include any document to include, and if the interim financial statement is included in any document, management should agree to include the auditor's review report, which indicate that the information has been reviewed. So if you are sharing this information with a third party, make sure you include the report so third party knows that this is a review. This is basically similar to management role in preparing the company's annual financial statement. Basically, if they are responsible for these things for the quarterly, they are responsible for these things for the annual. Now, what is our responsibility as auditors? Well, the first thing is we're going to have to conduct the review in accordance with the applicable standard. Those could be the SASs, the Statement on Auditing Standard, or the PCAOB. We have to follow the standards. Now, it's important to clarify that it's not an audit. Therefore, there's no opinion. Remember, this is a review. We're not giving an opinion here. We're going to be providing limited assurance, limited or negative assurance. Then we have in this letter spell out the limitation of the engagement. What is that? Well, a review does not provide a basis to express an opinion. We already said this. A review does not provide reasonable assurance that we uncover significant issues that could be identified in an audit. Also, we don't express an opinion on the company's internal control. We don't express an opinion, but this is a little bit different than the review engagement. We try to understand the internal control when we are performing a review of interim financial reporting for an issuer, publicly traded company. We try to understand. So if the auditor identifies significant deficiencies or material weaknesses, they must be communicated to the client. Also in the letter, we would kind of spell out clearly what is the financial reporting framework that we will be using. And of course, it's the interim one will be the same thing as the annual. So you cannot use cash for the interim, accrual for the gap for the annual. They have to be the same. Okay, this ensures that both parties, the auditor and the client, agree on accounting standard that will be followed. So this is basically the letter. What will be in the letter? Now, how the letter looks like, take this information and draft a letter. This is what the letter would look like. In addition to establishing an understanding with the client, we need to understand. So we establish the understanding. It's simply put, we kind of agree on what we'll be doing. The client will sign the letter, and now we are ready to do our job. What do we have to do first? We have to understand and learn about the entity. So to perform a review engagement, a review of interim financial reporting, we have to understand the entity, its environment, obviously the applicable financial reporting framework. Of course, this is our measuring stick, and not measuring tape, measuring stick, and the entity's system of internal control. We have to understand internal control, which is a little bit different. Why? Why do we have to do that? Well, to determine the potential misstatement. So we need to understand the business operation and the framework to identify the type of material misstatement that could potentially occur in the financial information. Also, this will help us in evaluating the likelihood. What is the possibility of something going wrong? Giving our understanding of the entity, its environment, the financial framework. Maybe we did a review for another company and we learned a thing or two. Now we're going to use that information since this company is in the same industry, similar to the company that we reviewed. Then it will help us evaluate the likelihood, giving the circumstances. Also, we need to select appropriate procedures, having an understanding of the entity, its environment, the financial framework, and the entity's internal control. It will help us determine the most appropriate inquiries and analytical procedures. What should you do? Now you want to go to Forhat Lectures, look at additional resources, lectures, multiple choice, AI CPA previously released questions to help you. Whether you are an accounting student, CPA exam candidate, the best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.